Hey, hey, good morning, traders and investors, and welcome back to our Wednesday live stream show. I'm your host, Bennett Tyndall with TradingAnalysis.com. We appreciate you all taking time out of your busy Wednesday mornings to join us. My goodness, June 29th, approaching the month of July. Summer should be a bit interesting. We've had some pretty crazy weather here in the great state of Texas. We apologize for not having a YouTube live stream last week. I was actually away battling the coronavirus, but I came away victorious, and not quite 100%, but I'm 96% past the majority of it. Never any fun, but glad to be here. Fortunately, while we were away, markets traded out pretty much as expected, and as we discussed the week prior, with a overall corrective rally, as I view it, in the indexes. The corrective rally found resistance yesterday. We had a big move lower. We're going to take a look at the charts in just a few minutes. Before we get to the charts, we're going to bring in the trading analysis team. As you can see, bottom left-hand corner of your screen, futures are mostly sideways this morning. We'll see how that translates into the cash session open. We've got about 24 minutes. Good morning, Terry, and good morning, Alex. How are you guys today, gentlemen? Welcome.
Doing just fine, Bennett. Doing just fine. So glad to have you feeling better, man. We missed you last week.
I tell you what, man, that was brutal. It was not fun. I don't know if it was a different variant. I had COVID once before, and when I had it before, it was like I'd wake up in the morning with a symptom. By noon or 1 o'clock, it was gone, and then the next day I'd have a new symptom, and that lasted for about a week. I even lost my taste and smell, back then. But this time around, man, it was like a complete mental fog. It was not fun. Not fun. So glad I was able to step away for a few days there.
How you doing, Alex? Good afternoon.
Hey guys, good morning. All good here. Just as you know, I had the milder version a couple of weeks back, but not to the extent that you had. So glad you recovered. It's a pretty big temperature here. People going slowly on vacations. Town is half empty, so you should see the air reports here. I mean, people piling in to go anywhere after 2 years of COVID. It's amazing how much of people are running away from towns, at least here in this part of the world.
For sure. Everybody's, it's summer. We've been in this for a year and a half, and people are just, they're itching to get out and have some fun. So hopefully the caseload stay down, but glad you're feeling better. It's never a dull moment with the way 2020 beyond has treated us. But glad to be here this morning. Go ahead.
Yeah, maybe airline stocks are up. I didn't track that.
We might take a look at that. All right, so hey, we're going to hit it. We've got a short window here. We want to get the content out. I'm going to take you through the indexes. We're going to take a look at the S&P and the NASDAQ specifically. I will show you a couple of the indicators and a couple of the signs that I was watching that helped, at least in my opinion, to substantiate the counter-trend nature of the rally that we've seen in the markets. And we've got something else planned here in just a minute. So, gentlemen, I'll be back on the other side, and we'll take it from there. See you guys in just a couple of minutes. I tell you what, you got to love the Stream Deck. Without the Stream Deck, firing multiple queues, it just wouldn't happen. So shout out to Elgato there. Let's hit it. Hard right edge of the MotiveWave platform. We're going to go full screen here, taking a look at the indexes, starting with price action in the S&P 500. What we're looking at here is a daily chart, essentially going back to the September 2018 high, as you can see, bottom left corner of your screen. 2941.91 was the intraday high back in September of 18. I'll never forget that number. It's trading around it, had a nice three-wave pullback, and then obviously a huge three-wave rally up into the pre-COVID decline. From the COVID decline, I've continued to kind of reiterate my view week after week that I still view markets as contained within the higher degree of trend. Said otherwise, I still think the overall bottom left to upper right-hand corner of the chart move on the weekly and monthly time frame is alive and well. And I do expect the current pullback in the indexes to ultimately resolve higher. I don't think this is going to be a long drawn-out bear market that takes out the COVID low. I could be wrong. If I'm wrong, we're going to continue to track the alternates with our clients over at Trading Analysis. So if you are interested in staying up to date with the day-to-day changes throughout the wave structure, we would encourage you to join us. So let's dive into it, and let's go ahead and zoom in on the highlighted area. We'll go off of the daily. I'll take you down to a 195-minute time frame. Here on the 195, we get exactly half-day bars, so 2 bars represents 1 entire trading session, which is why we use the 195 versus the 240. Looking at the price action, and it's been a bit of a subjective overall structure. There has been wave counts offered that would perhaps suggest we've just been in a series of 3 wave corrections, and the June 17th area low, June 16th, June 17th area low would mark the end of a complex move. And we talked about that a couple of weeks back. I continue to have my pushbacks. I still think that we have a series of downside moves still left to go. And what we looked at 2 weeks back, obviously we weren't here with you last week, but what we identified, I think it was the 16th, what would that be? That would be June 15th. June 15th, when we met, we looked at the way in which markets responded to the June 2nd high, suggesting that from late March into May 12th, we actually had a 5-wave completion. 5-wave completion gave way to a corrective wave 2 flat. That wave 2 flat unwinded fairly significantly as a result of the recent inflation data. Kind of spooked investors and the continuation move set in. When we met on the 15th, we discussed the idea that we should now see some sort of a corrective rally back in a wave 2 position. And that's essentially what markets have been doing while I was away battling COVID. And as you can see here, from June 16th, we rallied in a trend that I best count as a 3-wave progression, unless proven otherwise. That 3-wave progression, interestingly enough, met about a 61.8% retracement. The actual intraday high from yesterday was 39.45. But when you're coming from and this was a question one of our clients had this morning, when you're coming from 36.36 and you're looking at a retracement as potentially as high as 39.62, a move up to 39.45 is sufficient to satisfy, in my opinion, a test of wave 2 resistance. And in fact, yesterday morning, very shortly out of the open, I put a short position to work in the indexes. I started to go in lower, picking up downside put spreads out in July and August. So I do expect continuation lower. We've talked about the 3,600 downside objective. What was really interesting, I think, about the way yesterday's high unfolded was the 618. Well, we didn't quite meet it. We were very close. That margin of error is acceptable in this 3,900 point index. It was a 61% retracement in price and nearly time, exactly into the same candle. That's a very symmetrical wave 2 rally. And that, along with the subdivision that we were tracking with our clients, suggested to me that it was time to get risk off on this corrective rally. We also had, interestingly enough, just a basic trend line from your October lows through your February 24th low. You'll notice the interaction that we had here in May. Got above it briefly, got underneath it. So on the move back up, we were up against that trend line. We were up against the retracement resistance, and we had a big move lower yesterday in the indexes. Didn't close our short, but at the end of the day, short was already up 30% or so. So we're going to continue to look lower. Now, there are alternates that would suggest perhaps I am wrong, and perhaps there is a larger upside retracement to come. We're going to save that for our clients. If you're interested, we would encourage you to check us out, tradinganalysis.com. We'll be live with our clients here in about 46 minutes for our weekly member webinar. But for now, we're going to continue to look lower and respect the idea that this is a corrective trend with a series of 3-4-3-4s to exhaust on the downside. So that's the S&P 500. If I take you over to the NASDAQ 100, here in the NASDAQ 100, the technical resistance was a bit different in that we had a trend line actually just sourced from the downtrend in March, drawn through the June 2nd high. That June 2nd high delivered resistance. You'll notice here it was a perfect C equals A measured move rally, 61% retracement nearly in price and time, and the confluence of technical resistance in that zone did deliver a move lower. So again, I continue to look lower in the NASDAQ. Downside objectives at this point would include the 1618 at 10,330. Now I'll give you a little taste of what we're watching intraday in the markets with our clients. If I take you over to the chart of TLT, obviously we have seen a move up in the bond market, and we were simultaneously seeing a pullback, obviously, in yields. If I can find the chart here, you know what? I could just recreate it much easier. One of the telltale signs, at least in my opinion, when determining whether or not the June 17th low marked the end of the correction, or if in fact that was just a corrective rally in the indexes for equities, was the way in which the bond market rallied and the way in which the yield charts corrected. It was a C equals A measured move rally. In my opinion, at least for now, a very clear three-wave structure. If this were to be 1-2, 1-2, we'd have a degree violation. If this were to be a leading expanding diagonal, it'd be a bit unlikely. And then when we look at the yields chart, the chart of the 10-year yield, here in the 10-year yield, we did the exact same thing. ABC measured move decline, 618. We still have some objectives in the 10-year that would suggest 4% and higher is possible. Alex is going to take you through that in just a minute. But those were some of the signs we were watching. And then last but not least, of course, the chart of the SMH. Semiconductors, one of the most dominant industry groups within the technology sector. Technology sector being one of the most heavily weighted, the most heavily weighted S&P sector. And as you can see here, all we had was a three-wave measured move rally. So we're going to continue to take this one wave at a time with our clients. We think there are going to be several opportunities to take advantage of the expected continuation move lower. There's going to be some whipsaw. So again, if you're interested in the day-to-day, please check us out, tradinganalysis.com. That's it for me this morning. I've taken far too much of your time. We've got a special guest, company founder, now Director of Investments for New Age Wealth Advisors, Mr. Todd Gordon, joining us this morning. How are you doing, boss? Glad to have you on board.
Hey guys,
sir.
Good morning.
Good morning.
Good morning. I'm not a special guest. I'm here to support you guys. Glad you're feeling better, Bennett. Good morning, everyone. And let's see. One of the things that we're talking about here at TA is everyone on staff here follows their process and obviously Will has been taught the company way, but each guy and girl will approach it in a slightly different way, and we really embrace that. So what am I saying? It's okay, if I come in and say, I interpret things just slightly different. I don't think quite as bearish as Bennett is. And, nothing that Bennett said is wrong. I think I'm a little bit more bullish. And I think a good, healthy debate, within, the four of us who are professionals is a really good thing. And we encourage it. Right. So it's really challenging markets. There's a lot of cross currents. The speed of information is so strong right now. And that's why we named the wealth management business, which is, the next step, sort of the evolution of trading analysis, which is in its 10th year. So we were founded in 2012. So the name of the wealth management business is New Age, which the speed of information, the amount of information, it creates a lot of cross currents. And I think it's tough for traders. So, I'm going to come in and say, I think we might be corrective off the highs in the indexes. We have sort of hedged a little bit in the indexes, actually took some of the hedge off in our portfolios at New Age. So, and Bennett, I don't think it bothers you if I come back and say, I think it might be corrective. We'll see. And, Bennett's probably right. And I'll be the first one to say you're right. What do you think?
No, not at all. I completely agree with you, and I think having differences of opinion helps to kind of stoke the discussion and keep things on the right track. So I'm totally open and willing to accept when and where the market is ahead. So
we're literally trying to predict you're literally trying to predict the future, and to trade and invest well is not. It doesn't require us to be able to predict the future because it's impossible. It's doing everything we can to take all the available information, within our skill set and assess the now. So, one thing I was going to tell you a little bit of a story quickly. I don't want to take too much time. We're trying to be a little bit more sensitive of your time here on these webinars, on the Wednesday webinar, at least. But, the markets are tough right now, as I just mentioned. And Terry and I were having a good discussion yesterday. I just wanted to throw this by you. We have clients, on the wealth management side who will give us, 60, 70, 80% of the portfolio to manage, but then they'll handle the 20 and 30%, within the walls of trading analysis and following the work there. And, there's all kinds of different trading markets. There's markets where volatility is high and your methodology, your system is firing, you're on the right page and you're making a lot of money, or perhaps you're out of sync a little bit and you're not, things aren't quite following the way that you would expect them to go. And you just got to recognize what kind of market you're in. Either the market agrees with what you're doing, you're out of sync, or maybe the market's out of sync with itself. And, Terry and I were talking about trading, and I just wanted to tell you a quick story. When I used to trade, I traded for a hedge fund on Wall Street during the FX, during the global financial crisis, where the yen carry unwind was going crazy. And I was trading, I was a young trader, I was like 25, 26 at the time, and I had platforms behind me. I looked at the Goldman Sachs platform and Lehman and Barclays, and we had Deutsche Bank, and we had Lehman, believe it, and I traded FX on the Lehman platform. And as a young trader, during so much volatility, I found myself trading too much, going against my plan, getting in, getting out, putting a stop, moving it. I had too much access to institutional level platforms and high volatility. And at the same time, what I was doing is writing a research report called Strategy of the Day for the retail arm. And I'm going to spin this story into today's market, give you two charts to think about and maybe consider the story I'm telling you. So I was too active trading for the hedge fund, but I was writing the research report for Strategy of the Day, which was an Elliott wave and fundamental based research piece that came out once per day. And there was one trade idea. And after trading a bunch in and out on the platform and then writing the research report, I came to the realization that the best trades that I was doing were the ones that were thought out, that were pre-planned, that were written in the research report, and all the in and out and moving stops and doing all this crap was useless, and I was losing money doing that. So it actually came to the point where I uninstalled all the investment bank platforms, and I literally had to call into the desk and leave my order. When you're trading FX, Alex knows this. If you're trading, I was trading 2 million, 3 million, 5 million at a clip, which is nothing in FX. You call the Goldman Sachs trade desk and they laugh at you. But I said, you know what? I'm going to take the ability away from me to buy and sell, change my plan, second guess my good trade plan that I had set out and commit to it, because I'm not going to call Goldman and move my stop for 20 points on a 3 million order because they'd laugh at me. Right. So what my point is everything that we're looking at, the systems and the processes that you're learning from trading analysis, the way we look at the markets, they allow you to set a trade plan well into the future. And the best thing that you can do, and my trade plan is slightly different than Bennett's, and that's great, but stick to your trade plan. Don't second guess it. The best work you do is when the markets are quiet, when you have charts in front of you, when you have the fundamental data and the economic data, and you interpret it the best of your ability. So when markets are tough, have a plan. It's more important to have a plan and really do everything you can to stick to the plan. I hope that makes sense. If anybody wants to jump in, certainly say that again.
I said very sage advice, Todd. I mean, that's the thing. It's just too easy to have the TV on in the background, listening to the talking head say something that makes you question what you just sat there and thought out, and you set your trade plan and you said, this is where I'm willing to buy, this is where I'm going to exit. If I'm wrong, I exit with a small loss and I learn and I move on. And then this is my target. The other thing you got to do is you got to watch those targets. You start seeing the top stock move in your direction, and if it moves up to your target, your emotions are going to start getting involved as to whether or not you pull the plug. When do I pull the plug? That was another hard decision. Most of the time,
it just saved myself embarrassment. And what saved myself embarrassment, again, trading on the Goldman desk, I was trading euro at the time or dollar yen, like, okay, euro. I'm a buyer at 115.50 for 3 million. I'll put a 114.75 stop loss for 3 million. I'll put a take profit for 1.5 million at 116.75. If done, move the stop to break even. So I would leave very explicit instructions so that I didn't bother the Goldman guys, because you call Goldman Sachs FX desk, you better be trading 20 million at a clip at least. They don't get out of bed for less than 20 million. Right. But it forced you to put your trade plan in front of you, and the crazier markets get, the better chance you have in whatever methodology you look at. So tying into today, can you guys throw me? Oh, it's already up there.
Nope, going on right now.
Okay. So in the tactical dividend right now, and I'll be real quick here. I'm already over my time, but we have energy. We've been overweight energy pretty significantly in our alpha strategy. We launched that way. Right now, I can just pull this up right now. Allocations. I think we have about a 12% allocation in New Age Alpha in energy. So it's 12.9%, which I think represents about, I think the S&P is 4%-ish energy in the S&P. And I grade out the holdings, but I just wanted to show you a few of these guys in terms of holdings. And I don't mind the energy holdings that we have in the growth portfolio. And Enphase is a solar company. It's more tech, but it kind of represents, I think it trades like a technology company. I wanted to show you that one. I also wanted to look at Devon. Devon is a 1.75% holding. It's down to 1.52 with drift. We've come off quite a bit. And I just wanted to show you, when the trade plan changes, specifically for Enphase, I'm going to make a move. So ENPH, just some simple technicals. I won't get into the fundamentals right now, but boy, that's a pretty common pattern that you guys have seen. Left shoulder, head, right shoulder. We are starting to hold some resistance here. We have the 618. You could probably put a candlestick with a couple tails up into the 618 to 786. We have a potential reversal here in Enphase. As much as I love this stock, I've had it for a long period of time. And it's really pretty simple. As soon as you break trend line support about 102.5, I'm really going to have to think about taking this thing off. In fact, that's going to be my plan. I have a plan as much as I like it. You take a look at, Devon. Devon Energy has come off significantly. It's one of my favorite stocks. Terry, I'll give you crap. You told me not to buy it at $10. I love you. Don't get mad, but you did. I'm just kidding. So we have a potential wave for a pullback here. Energy has been rotating out. If we start to break through support in Devon, I am going to have to exit the position, or at least lighten up. So I'm going to have a plan going into it. One that I wanted to throw in front of you guys, which is related to the story I told you, is the crypto market. Alex is going to tell you about some wave 4 pullbacks here. Long story long, I should say. Back in those days when I was trading FX, I was working for a retail brokerage, writing that research report, forex.com. And there was a big blow up in the FX markets when the Swiss National Bank pulled their peg on Euro Swiss, and it blew up FXEM. It was crazy. So with enter crypto, I've seen sort of FX platforms come and go. Coinbase, okay. I don't like all the things that are happening right now in the crypto market, and Alex is tracking some wave 4 support, and I really hope it happens. But speaking of a trade plan, I've seen unregulated platforms come up. Coinbase CEO, I don't really like some of the commentary he made in terms of potentially deposits being not secured. I took my money out temporarily. I cleaned everything out, and I'm willing to put it back in. But I guess the point that I'm saying is I've seen this show before with FX platforms. I'm wondering if Coinbase has another leg lower with or without Bitcoin breaking the figure level right here where it's at, without holding 20,000. So, you could easily do a little 1-2 setup here down in wave 5. And I think, Coinbase, I think, is going to continue to come under pressure. Robinhood, obviously there's a lot going on with HOOD, sort of, I think as Josh Brown said correctly, kind of preying on the bubble that the retail traders face. And again, those are the retail traders that don't have a plan. So I think Coinbase might have another leg lower, and I might be looking to do a little option short there. So just wanted to put that out there, kind of tell you that story in crazy markets, in the FX markets during the global financial crisis, which it was all about FX with the end carry unwind. Now we have crypto, and now we have crypto brokers. They're coming under the same test. Crypto is an asset class that's going to be here forever. But whatever market you're trading, have a plan and be confident whatever methodology you're looking at when markets are crazy. Okay, thanks for the time, guys. I hope that helps.
Much appreciated. Thank you so much, Todd, for joining us, and hope to have you back soon. Hey, you
pleasure,
know
guys.
what's interesting before you go on Coinbase there, the day Coinbase IPO'd was the April Bitcoin top of 21.
I know it. I know it. And
It's just,
I was on CNBC and I kind of told that same story. I said, don't touch Coinbase, and it topped Bitcoin. That's crazy.
yeah, that was
Talk
quite
about
the session.
offloading to talk. Bennett, here's a joke for you. It's just kind of leaving a bad taste in my mouth.
I can't taste anything right now, so you know. Coffee tastes like warm
Hey,
air.
that joke was in poor taste.
Oh, God.
Oh, there you go.
That was a good one. That was good. All right, sounds good.
All right,
make
my
fun
turn.
of your ailments.
No worries, man. I love it. I love it. Markets are open. Terry's going to take you through Optima. We'll be back on the other side, take you through the macro scene with Alex, and then we'll let you guys get out of here and enjoy the rest of the session. Mr. Terry Long, you ready to rock?
Oh, yeah.
All right, take it away. We'll be back in just a few minutes. Thanks, Todd.
Thanks, guys.
Take care.
Hello, traders and investors. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. Well, we opened the first official week of summer with a substantial relief rally in the markets, only to see some of those gains fading sharply this week. Now, although last week was a shortened trading week, every single day last week saw positive gains in both the S&P and the NDX, and a big push up on Friday. S&P scored 6.45% on the week, while the tech-heavy NDX scored 7.45%. That's up 1%. I'll just note that the growth sectors are outperforming the broader market on the way up in a larger magnitude. So I found that interesting. Last week, this is last week's sector performance chart over here. We saw 10 of the 11 sectors netting positive gains, energy being the only lagging sector. Now, in the prior week to this, energy was down 17%, and last week it tacked on another 2.5%. So it's no surprise this week that we're seeing a bit of a recovery rebound in energy, which I'll touch base on in just a moment. But last week, the consumer discretionary sector rallied 8%. That was pretty huge move. Tech sector was up 7%. The real estate sector managed nearly a 7% bounce, and it was followed by healthcare and communication sectors. Now, value sectors, utilities, staples, financials, industrials, and materials were all lagging behind the S&P. Yes, while they did make positive gains, they clearly underperformed the benchmark. Now, we'll fast forward to this week. Let me pull this little table over here and show you. So, like I said, coming off of two really sharp declines in energy, we are getting that bounce, and I think Todd is onto something there. He's going to be looking to play into this bounce and take some profits off the table. I mean, good Lord, energy has been a dominant player this year. We certainly wouldn't want to lose those gains once energy decides it wants to roll back. So this is just Monday and Tuesday's price action here. Utilities and energy only being the two higher. This table here includes this morning's action, and we can see energy is now pegging 7% rebound, with utilities also up. The other sectors are fading. It's the consumer discretionary sector down here at the bottom, and 9 of the 11 sectors are now lower, with the consumer discretionary already down 5.22%. We've seen big pullbacks in Tesla, Amazon, Nike, and Etsy that really have been hurting this market. Fast forward over here to our relative strength sector leader scoreboard. You can see energy is still the highest relative strength, but it is now continuing to descend into the weakening quadrant. After a big hook reversal here, we see evidence of both momentum and relative strength declines as this vector is moving in a southwesterly heading. The utility sector is also moving in a similar fashion, and at the time we're writing this, we now see a penetration of it down into the weakening quadrant. You're also seeing a common theme amongst all of these leaders here. In our former leaders all have these southwesterly vectors. Now, one interesting thing to note, the structure of how this RRG works, the benchmark is the S&P, and all 11 of these sectors make up the, they have to be in balance, obviously. But we've got sectors exiting the leading quadrant. There's going to be something that's coming up behind it because it has to play in balance. If we see these sectors, such as the real estate sector, look how close the real estate sector is now to pushing into the lagging quadrant. The more of these start to fade out here, in order to keep the chart in balance, something's going to be coming back into play. And I think that something might be technology. Look right here. I've got 3 vectors in a row now with a northeasterly heading. Yes, I don't have the weekly blue vector, improving trend vector that I really like to see to tell me that's happening, but definitely we've got action happening here back in the technology sector. Now, the consumer discretionary sector, it remains a bit unclear as to its intentions, and with the 8% gains last week but a pullback this week, the momentum loss had kind of shifted to neutral, but now maybe it's fading for one more decay here. I'm going to monitor this sector closely for signs of a completed northerly hook formation, which when I was looking at this Friday, this is what I was seeing over here. We'll zoom in on that a little bit. I wrote all this for Sunday, and looking at this, I almost thought we were starting to form that corrective hook. Now, I will tell you, this is Monday and Tuesday's price action only in this vector, and since I'm on a weekly chart, I still got Wednesday, Thursday, and Friday to make the completion of this this tail, so we could actually see it. Now, on the other hand, we are seeing some positive action here in the communications sector. It had been slowly inching its way eastward, gaining some relative strength with a fairly neutral momentum. Now I'm getting a bit of a momentum kick. So, all right, that's really all for me, guys. If you want more of this, come join us at Trading Analysis, become a subscriber. I go through a lot more detail in my other charts for all the sectors, cover a lot of stocks in there, and I help our subscribers out with their trades. All right, I want to leave it there. Back to you, Bennett.
Thank you so much, Terry. Much appreciated. That communication sector, we had that move north from the lagging quadrant. It made its way into the improving quadrant. It's been hanging out there for quite a while. So very curious to see how that wraps up the week. All right, Mr. Alex, sir, we're getting the screen past your direction. Markets are open. We've been open here about 8 minutes. S&P 3810 coming off 3800 handle area low. You ready to rock, sir? Take us through the macro scene?
Yeah, let's roll.
All right, let's hit it. We'll be back on the other side to wrap up.
Hey guys, let's review a little bit of a macro developments, going through a couple of charts. CME Fed tool, usually market expectation where the Fed's rates will go. That's of course a fund rate. So next meeting 75 basis points, but as you can see in September, market is starting to price a little bit of I will say 50 basis points, has a 67.2% lead. It's kind of a market expecting that this announced demand destruction will take its toll, so the Fed is going to slow down with, and that's an interesting point. So I think we should follow the June meeting, especially what the figures will be with inflation and all other stuff, so employment. So we will see, and actually potentially we will see Fed starts to decrease its rate increases until the end of 2022, maybe even beginning of 2023. That's kind of aligns well with our assessment that we are in the last move on the rates on the upside. Bennett has this as a complete five-way move on the upside. I'm looking just a same move, but potentially in the ending diagonal version. I don't see quite, you can count 5 waves, but it can also be interpreted as a 3-wave move. So depends what we are going to do here, because when you have the ending diagonals, there is a strict measurement between the interrelation of the waves inside. So if the wave 1 is the longest one, or when you have a contracting version, the wave 3 will be shorter than wave 1, and wave 5 will be shorter than wave 3. So if you see some of these developments up to this 3.75 and a strong reversal, that will actually end this 5-wave move. And we can expect for a couple of months a relief move lower actually in rates. We will see in which form they will take, but I've been pounding the drums for the last couple of weeks that commodities are going to go down, and we have seen a couple of commodities really going relentlessly lower, like copper and couple of others, which I'm going to show you. So that will affect possibly also the inflation figure, and this kind of outcome for the next 6 months or a year, it's a quite visible, I think, already in this spectrum. If we go to Europe, amazingly, ECB is still at 0, and the last readings is Spain on inflation, it's 10.6. They are trying to level up the spreads between the government bonds of Italy and Germany. And of course, you have many other peripheral countries which might be in trouble if the ECB starts hiking rates to a certain degree. So they're still debating how they can narrow the spreads. Actually, they said they're going to buy Italy debt and actually sell the German one, which was a very interesting thing to hear. So in that respect, the chart is actually saying that we are going to see more upside on the German 10-year Bund, which means that rates will definitely go higher, but we will see on which pace from the ECB side. So a very impulsive move on the upside. This usually vertical uprise we characterize as a wave 3 of 3, and the angle of ascent is almost 90 degrees. So I do expect a little bit of a pullback, and then a continuation of the upside where the intermediary wave 3 will actually complete, pullback in 4, and move up in 5. So whenever you have a 5-wave sequence from considerable move, almost 40 years move lower, if I show you this deflationary cycle, almost a secular, it's a secular cycle on the downside. When you have a 5-wave move on the upside after some type of this event, you either have a flat here, which is not the case, which actually is telling us that after a pause, we're going to have at least one more leg on the upside. So inflationary thing will not complete, at least looking at this chart in Europe, possibly in US, for I think next year or even 2, while this plays out, and then we can maybe go into a little bit more deflationary cycle. So we're going to stay with inflation. Probably the economy will adjust. We have geopolitical tensions, all other stuff. So charts sometimes can be very telling in this respect. Dollar index still moving on the upside in accordance also with rates and a couple of other things. So I do see dollar stronger for the next couple of months. Possibly until the end of 2023. This will take some time to develop, but I don't see it going much higher from this 104, most likely after a pullback, 106, 107. I'm not going for a higher target for now because they're at 110 and 112, which will be pretty detrimental for emerging markets because there is a lot of debt denominated in the US. And that can cause some currency crisis in the emerging markets. So let's move to the Thomson Reuters Commodity Index. I still have a view 5-wave move on the upside are done or is done. So I'm looking for clues for a bigger correction there in line with rates, because this goes very well. If you overlay 10-year yields, you will see they basically move almost the same. So the pause in commodities will give us a pause in yields, move on the upside. So this couple of charts in commodities really agrees of these assessments for the next couple of months. If you look net gas, it levels of 1618, which we definitely showed much before that this happened, actually worked out nicely. I don't know if this is going to be a triangle, but seasonality definitely points out for some type of a consolidation. We might have either a drastic move lower in net gas prices if this turns to be a complex, but generally these 1618 levels, which we measure for the potential intermediary wave 3 targets, is behaving well for now. This is an impulsive move lower. We can stay in a triangle or have a more lower prices in a complex correction before we come, of course, to let's say October, November, when the gas consumption will start picking up. And of course, in the winter, you can expect just seasonally, on top of this global wreckage in the gas prices, definitely I see them higher after a summer period and this consolidation actually pass. The oil prices are still capped in a triangle. We have moved lower, and now we are still moving back higher. For the last couple of days, we are trading, this is the Brent crude, at 120 almost. So we are still capped in this consolidation. We don't break on the upside or on the downside. And as long as this trend or this consolidation stays in a range, it has more chances to actually break out in the direction of a trend. And that will be, of course, upside, as you see on the chart. So I will stay with my outlook that oil prices will continue moving higher after this consolidation is done, provided we keep these 95 levels intact. In the case we drop below, we'll have to change the outlook. But for now, I've been looking for this for many weeks, and it is just saying to me that this starts to consolidate and compiling the energy for the breakout more and more every week it passes. So I'm going to look obviously higher for the oil prices. If we look gold and silver, so silver has been moving lower. I have explained that this consolidation doesn't give us much of a ability to predict or kind of a forecast any upside move in silver. We have broken this 400 and something days support level, not by much. We can still stay some time here, but if you look, sorry guys. Guys, there is some works, just the neighbor is working. So let me just go back to silver and look this. I think it's going to go lower, and then gold quickly because they're starting to work here. Still nothing on gold here. There are not sufficient evidence. We're going to continue higher. Moreover, we might go lower. So sorry on the noise, guys. It's a neighbor is doing some construction work. So that's from me, Bennett. Back to you.
Very good. Much appreciated, Alex. No worries there on the background noise. It happens. In my case, it's usually my dog in the office, no worries. Yeah, that gold move, that moved to 2078 and 80, I think it was. You've got to view that as a corrective rally at this point. The three-way pullback, it tried to deliver a bit of a relief move, but we just have not been able to maintain a bid in gold. So I'm with you. I think we do press lower there and test that zone.
I mean, as we know, when we see and expect some type of impulsive move, after some time it needs to happen. So more time passes and we don't see this actually break out on the upside. We have to start to doubt that actually we're going to see that breakout, and then we can look at it more as a consolidation as it happens in silver and it's breaking lower. So it's useful very much to look the time aspect. Because I think there is a limited time when you are expecting some more.
Oh, good Lord.
Absolutely. No, you're spot on with that. It's just, you know, it could have been a little bit of a wave 2 pullback. It just, the time wasn't on our side there. It just did not maintain a bid. So, hey, appreciate you guys. Alex, Terry, thank you so much. Viewers, hope you guys enjoyed the content. If you're interested in any crypto-specific coverage, check us out, tradinganalysis.com. Also tune in tomorrow morning, same YouTube channel, 9 a.m. Eastern for Crypto Lab with Alex. And we'll be back same time, same place next week. Members, we'll see you in 11 minutes for our weekly member webinar. For those of you curious, our weekly member webinars are anywhere from an hour and a half to 2.5 hours, depending on the session. And we'll see what markets do. S&P holding 3,800. could get a bit of a corrective bounce following yesterday's move. We're going to find out. Appreciate it. If you enjoyed the content, give it a thumbs up, subscribe with notifications. Alex, Terry, excellent work. And we'll be back next week. Sounds good?
See you later, guys.
All right. Alex, see ya. Terry, see ya. And we'll be, members will be with you in 10 minutes. Have a good one, viewers. Catch you next week.